Gold just moved above $2,150 an ounce. At first glance, that may sound like just another price milestone. Markets rise, markets fall, headlines come and go. But this move did not happen in isolation. It came at the same time banks began tightening liquidity, adjusting internal risk models, and quietly pulling back from certain types of lending. Those two events, happening together, matter. When gold pushes through a major psychological level, like $2,150, it is not only a technical breakout, it is a signal. Large institutions do not allocate billions of dollars based on emotion. They move capital when something changes in the structure of risk. And right now, something has changed. To understand why this level matters, we need context. Gold does not generate income. It does not pay dividends. In normal periods, when interest rates are high and confidence in banks is stable, gold tends to struggle. Investors prefer yield. They prefer assets that produce cash flow. Yet, here we are. Interest rates remain elevated. Bond yields are still historically high compared to the past decade. And gold is rising anyway. That divergence is the first clue. At the same time, banks are not behaving as if everything is normal. Lending standards have tightened. Liquidity buffers have increased. Regional institutions are becoming more cautious about balance sheet exposure. Even large global banks are quietly strengthening capital positions and reducing duration risk. This is not panic behavior. It is defensive positioning. When banks restrict credit, they are not simply reacting to today's headlines. They are preparing for tomorrow's stress. Banks sit at the center of the financial system. They see deposit flows in real time. They monitor loan performance across industries. They understand where leverage is building and where it is starting to crack. So when gold breaks higher, while banks pull back, we have to ask a deeper question. What is the market seeing that is not yet obvious? Historically, gold has acted as a barometer of trust. Not just trust in inflation data, but trust in institutions. During periods of systemic strain, when confidence in financial plumbing weakens, gold often moves before the broader public fully understands why. But this is not 2008. It is not a sudden collapse. There are no dramatic bank runs dominating the headlines. Instead, what we see is subtle, quiet liquidity facilities, adjusted collateral rules, increased use of emergency funding, backstops, technical measures that stabilize the system without attracting attention. On the surface, everything appears orderly. Beneath the surface, the system is adapting. That is why the $2,150 level carries weight. It signals that capital is hedging something structural, not necessarily immediate inflation, not necessarily geopolitical panic, but a shift in how risk is being priced inside the banking network. There is also a psychological component. Round numbers matter. When gold crosses a previous ceiling, it resets expectations. Portfolio managers who once viewed $2,000 as resistance must reconsider their assumptions. Risk committees begin revisiting exposure models. Momentum funds activate new signals. The breakout feeds on itself, but only if the underlying reason is real. And this time, the timing is difficult to ignore. Banks tightening, credit contracting, gold climbing. When trust moves, money follows. And when money begins repositioning quietly, it rarely announces its full intention at once. So we arrive at the central tension of this moment. Is gold reacting to lingering inflation fears? Or is it responding to something more fundamental, something inside the banking system itself? Because if this rally is about inflation, the explanation is simple. But if it is about the stability of financial intermediaries, the implications are far deeper. To answer that, we need to look beyond the price chart and examine what has changed in the rules of the game and why. Traditional market relationships may no longer be holding. To understand whether this rally is about inflation or about something deeper, we have to start with the rules that normally govern markets. In a typical cycle, higher interest rates strengthen a currency and pressure gold lower. The logic is straightforward. When Treasury yields rise, investors can earn more income holding government bonds. Gold, which produces no yield, becomes relatively less attractive. Capital flows toward income-generating assets, and precious metals soften. That relationship has held for decades. It is one of the most consistent correlations in macro finance. But today, that correlation is weakening. Policy rates remain restrictive. Real yields, adjusted for inflation, are still elevated compared to the years following the global financial crisis. By traditional models, gold should be struggling. Instead, it is pushing higher. When a long-standing relationship breaks, it is rarely random. Correlations break when regimes change. This is where the signal becomes more important than the headline. The breakout above $2,150 is not just a technical event. It is a divergence from expected behavior. And divergences often reveal stress beneath the surface. To see why, we need to look at bank balance sheets. Over the past several years, banks accumulated large portfolios of government bonds when rates were near zero. At the time, those securities appeared safe, but as rates rose rapidly, the market value of those bonds fell. The losses were often labeled unrealized, meaning they did not immediately impact reported earnings as long as the assets were not sold. On paper, everything appeared stable. In reality, the system absorbed a hidden shock. Trillions of dollars in bond portfolios declined in market value. As long as deposits remained steady and funding was stable, banks could hold those bonds to maturity. But once deposit flows began to shift, the situation changed. Deposit flight does not need to be dramatic to matter. Even gradual outflows force institutions to raise liquidity. To do that, they may need to borrow, pledge collateral, or in some cases, sell assets at depressed prices. Each of those actions tightens financial conditions. This is where emergency facilities enter the picture. Central banks created lending backstops to allow institutions to borrow against securities at favorable terms. These facilities stabilized the system. They prevented forced selling. They restored confidence, but they also changed incentives. When banks rely on emergency funding channels, even quietly, it signals that private liquidity is no longer sufficient. The plumbing of the system becomes more fragile, and markets are sensitive to fragility. Gold tends to respond not to headlines, but to structural shifts in confidence. When investors sense that the financial architecture requires ongoing support, they begin hedging systemic risk, not because collapse is imminent, but because uncertainty has increased. Historically, periods when gold rises despite tightening policy often coincide with deeper stress. In the late 1970s, real rates struggled to keep pace with inflation expectations. In the early 2000s, gold advanced even as growth appeared stable, reflecting rising debt imbalances. During the post-2008 era, gold surged as unconventional policy reshaped monetary credibility. Each time, the signal was not obvious at first. It became clear only in hindsight. Today, we see elevated yields, cautious banks, and gold pushing through resistance simultaneously. That combination suggests that markets are adjusting to more than inflation data. They are adjusting to the possibility that the financial system itself is operating under strain. This reframes the narrative. Instead of asking whether gold is expensive, we ask what it is pricing. Instead of focusing on daily volatility, we examine structural incentives. Banks are conserving capital. Credit standards are tightening. Liquidity facilities remain active in the background. Markets are forward-looking systems. They anticipate shifts before they are fully visible in economic statistics. When long-standing correlations break, it often means the framework investors rely on is evolving. And when frameworks evolve, power dynamics shift. Because beyond interest rates and bank balance sheets lies another layer entirely, one that involves physical supply, sovereign strategy, and global leverage. To understand why gold is rising now, we have to examine who is accumulating it, where it is flowing, and how that reshapes the balance of power beneath the financial surface. To understand who is accumulating gold and why, we have to widen the lens beyond trading desks and interest rate charts. Gold is not only a financial instrument, it is a physical asset that moves through mines, refineries, vaults, and central bank reserves. Its price reflects not just investor sentiment, but state-level strategy. Unlike bonds or equities, Gold does not depend on a promise from a government or corporation. It is final settlement. That characteristic makes it uniquely valuable during periods of geopolitical tension and monetary uncertainty. Over the past several years, central banks have been consistent net buyers of gold, not in small amounts, but in volumes that rival historic accumulation periods. This trend is not driven by retail demand or short-term speculation. It is driven by sovereign reserve management. Why would central banks increase gold holdings when interest rates are high and dollar assets still offer yield? The answer lies in diversification and leverage. For decades, the global financial system has revolved around the US dollar. International trade is priced in dollars. Sovereign reserves are heavily allocated to US Treasuries. Cross-border lending and settlement flow through dollar-based networks. This structure grants stability, but it also concentrates risk. When geopolitical tensions rise or sanctions expand, the neutrality of reserve assets comes into question. Countries that rely heavily on dollar reserves may begin to reassess their exposure. Gold, by contrast, carries no counterparty risk. It cannot be frozen electronically. It does not require access to a foreign payment system. This is not an ideological shift. It is a risk management adjustment. Emerging economies, particularly in Asia and parts of the Middle East, have increased gold allocations as part of broader reserve diversification. The trend is gradual, but persistent. Over time, even modest reallocations can shift demand meaningfully. Physical flows tell an important story. Western investment demand, often expressed through exchange-traded products, tends to be cyclical. It rises during crises and falls during calm periods. Eastern demand, by contrast, is often driven by long-term savings culture and official sector buying. In recent years, physical gold has increasingly flowed from west to east. Refined bars, shipped from London and Switzerland, move toward Asia, where central banks and private buyers accumulate. This pattern suggests that gold is being absorbed into long-duration holdings, not short-term trading inventories. That distinction matters. When gold is accumulated as a strategic reserve asset, it is less sensitive to short-term price swings. It becomes part of a structural allocation. That steady demand can underpin price strength even when traditional financial models argue otherwise. At the same time, banks in advanced economies are doing the opposite. They are reducing risk exposure. They are tightening credit. They are protecting capital buffers against potential loan losses and bond volatility. This creates a quiet tension within the global system. On one side, sovereign actors are accumulating a neutral asset that sits outside the credit system. On the other, private financial institutions are contracting, lending, and reinforcing balance sheets within that system. One side is building reserves, the other is conserving liquidity. It is a subtle tug-of-war. When banks tighten credit, economic activity slows. Slower growth can pressure corporate earnings and asset prices. That, in turn, increases the appeal of reserve assets perceived as stable. Sovereign buyers, with long-time horizons, may see current conditions as an opportunity to strengthen monetary independence. This is where gold's breakout above $2,150 begins to look less like a reaction and more like a reflection. It may reflect a broader rebalancing of global power. Not a sudden shift, but a gradual redistribution of leverage. Control in the financial system does not come only from interest rates. It comes from who holds reserves, who controls settlement networks, and who can provide liquidity during stress. If more countries diversify reserves toward gold, the architecture of global finance evolves slowly over time. None of this implies the end of the dollar or the collapse of existing systems. Structural shifts rarely unfold in dramatic fashion. They happen through incremental adjustments that accumulate year after year. But markets are sensitive to direction, not just magnitude. If central banks continue to accumulate gold while private banks contract credit, the combined effect can reinforce upward pressure on the metal. The breakout becomes part of a longer narrative about resilience, sovereignty, and option. And yet, gold does not exist in isolation. Its rise interacts with currencies, debt levels, and monetary policy decisions. As sovereign buyers strengthen gold reserves, Policymakers must consider the implications for their own currencies, because when reserve preferences shift, even gradually, they influence capital flows, exchange rates, and long-term inflation expectations. To understand the full impact of this quiet power realignment, we have to connect physical accumulation to the monetary system itself and examine how gold's strength feeds back into currencies, debt markets, and the value of money over time. When reserve preferences begin to shift, even slowly, they ripple through the monetary system. Gold does not replace currencies, but it competes with them as a store of value. And when gold rises decisively, it often forces a deeper question. What does this say about confidence in money itself? To answer that, we need to examine the environment banks are operating in today. Credit is the lifeblood of modern economies. When banks expand lending, businesses invest, consumers spend, and growth accelerates. When banks tighten standards, the opposite happens. Loans become harder to obtain. Expansion plans are delayed. Housing activity slows. The effect is gradual, but measurable. Right now, many banks are prioritizing capital preservation over loan growth. That shift reduces the pace of credit creation. Slower credit growth typically leads to slower economic momentum. Under normal circumstances, central banks respond to slowing growth by easing policy. They lower rates or inject liquidity to prevent contraction from becoming recession. But today's environment is more complex. Debt levels are high across both public and private sectors. Governments carry large fiscal deficits. Corporate balance sheets reflect years of cheap borrowing. Households face higher financing costs than they have in over a decade. When growth slows in a high-debt system, policymakers face a dilemma. If they keep rates high to protect the currency and control inflation, they risk amplifying financial stress. If they ease policy to support banks and borrowers, they risk weakening the currency and reigniting price pressures. This tension is where gold enters the picture. Gold often rises not only during inflation spikes, but during periods when markets anticipate future monetary accommodation. Even if headline inflation appears to cool, investors may believe that the next phase of policy will involve renewed liquidity support. In other words, gold does not react solely to current inflation. It reacts to expectations about future purchasing power. Consider the mechanics. When central banks create emergency lending facilities or expand balance sheets to stabilize banks, they increase the availability of base money. These actions may be framed as temporary or technical. They may not immediately show up in consumer price indices, but they alter the trajectory of monetary supply. Markets are forward-looking. If investors believe that structural debt burdens will ultimately require easier policy, they may allocate toward assets that preserve value across cycles. Gold becomes a hedge not against today's data, but against tomorrow's policy response. This is why gold above $2,150 carries symbolic weight. It reflects more than a commodity rally. It signals that market participants are reassessing the long-term credibility of fiat purchasing power. Currency credibility rests on trust and discipline. Investors must believe that policymakers can manage debt without excessive monetization. They must believe that inflation, once controlled, will remain contained without constant intervention. But when banking stress requires liquidity backups, and when sovereign debt continues to expand, that belief can weaken at the margin. The hidden consequence is rarely immediate collapse. Modern financial systems are resilient. They adapt. They absorb shocks. Instead, the consequence is gradual pressure. Currency values erode slowly relative to real assets. Purchasing power shifts over years, not weeks. Gold functions as a mirror in this process. When it rises steadily, despite restrictive policy, it may be reflecting expectations that current restraints is temporary. Markets may be anticipating that sustaining high rates in a leveraged system is politically and economically difficult. This creates a feedback loop. Bank stress encourages precautionary liquidity measures. Liquidity measures expand monetary support. Expanded support raises concerns about future currency dilution. Those concerns increase demand for gold. Rising gold reinforces the perception that monetary accommodation will eventually return. None of this guarantees runaway inflation or currency crisis. It does, however, suggest that the balance between stability and discipline is becoming more delicate. At the same time, sovereign accumulation of gold adds another layer. If central banks diversify reserves incrementally, they reduce marginal demand for foreign sovereign debt. Over time, that can influence bond yields and currency dynamics. Even small shifts in reserve allocation can alter long-term capital flows. So gold's rise is not just a reaction to banking stress. It is connected to debt sustainability, policy constraints, and global reserve behavior. It sits at the intersection of private sector caution and public sector obligation. For individuals watching from the outside, these dynamics may feel abstract, but they filter into everyday life through borrowing costs, investment returns, and the purchasing power of savings. When credit tightens and currencies face subtle pressure, households and businesses begin to feel the effects in tangible ways. To understand what this means on a personal level and how to interpret these signals without overreacting, we need to translate systemic forces into practical mental models. When these forces move through bond markets and central bank balance sheets, they can feel distant, but their effects are not distant at all. They filter down into hiring decisions, mortgage approvals, retirement portfolios, and small business loans. When banks tighten lending standards, fewer marginal borrowers qualify for credit. A business that might have expanded with a new line of financing now delays that decision. A family that could have stretched for a home purchase waits another year. A startup that depended on flexible credit terms trims its growth plans. None of this makes headlines on its own. But together, these small decisions slow economic momentum. Retirement accounts feel the shift through asset volatility. When liquidity contracts, risk assets can become more sensitive to negative surprises. Equity markets may swing more sharply. Bond prices can fluctuate as investors reassess growth expectations and policy paths. For long-term savers, this environment feels less stable, even if it is not catastrophic. Housing markets respond quickly to tighter credit. Higher mortgage rates and stricter underwriting standards reduce transaction volume. Prices may not collapse, but activity cools. Construction slows. Related industries adjust. The ripple spreads outward. Small businesses often experience the pressure first. They rely heavily on regional banks for working capital and expansion financing. If banks become cautious, entrepreneurs must either accept slower growth or seek more expensive funding alternatives. All of this connects back to liquidity. A useful mental model is simple. Liquidity is oxygen for the financial system. When oxygen is abundant, activity expands easily. When it becomes scarce, even healthy participants conserve energy. The system does not immediately fail, but it moves more carefully. Another helpful framework is that trust flows before money flows. Financial systems run on confidence. When trust and stability increases, capital circulates freely. When trust becomes uncertain, money pauses. Institutions hedge. Households save more defensively. Even small shifts in confidence can influence large pools of capital. Gold's rise during a period of tightening can be viewed through this lens. It may not signal panic among everyday investors. Instead, it may reflect institutional hedging. Large asset managers and sovereign entities often move early, adjusting portfolios before stress becomes visible in economic data. This perspective reduces emotional reaction. A gold breakout does not automatically mean crisis. It may indicate precaution. The third mental model involves regime change. Markets operate under sets of assumptions about inflation behavior, interest rate responses, and correlations between assets. When long-standing relationships break, it suggests that the environment is evolving. For years, investors relied on predictable interactions between stocks, bonds, and commodities. If inflation rose, rates rose, and gold moved in certain patterns. If growth slowed, bonds rallied. When these patterns weaken or invert, it signals a shift in regime. Recognizing regime change early allows for calm analysis instead of reactive decisions. Taken together, these frameworks create structure. Liquidity as oxygen explains why credit tightening slows activity. Trust preceding money explains why capital reallocates quietly. Regime change explains why traditional models may fail. Understanding these ideas helps individuals interpret gold's move above $2,150 without jumping to extremes. It may represent institutional repositioning in response to subtle stress, not widespread fear. The key is perspective. Financial systems are adaptive. They rarely collapse overnight. They evolve through pressure and response. But evolution does not mean predictability. From here, several paths are possible. Some lead toward stabilization. Others point toward renewed accommodation or deeper adjustment. The next phase depends on how policymakers, banks, and global actors respond to the signals now emerging. From this point forward, the path is not fixed. Financial systems do not move in straight lines. They respond, adjust, and adapt. The breakout above $2,150 is a signal, but it does not dictate a single outcome. What matters now is how the system absorbs the pressure that signal represents. There are three broad scenarios worth considering. The first is stabilization. In this path, banks continue tightening cautiously, but avoid major credit events. Liquidity facilities remain available, but are used less over time. Deposit flows stabilize. Economic growth slows modestly, but does not contract sharply. Inflation continues, cooling gradually, allowing policymakers to maintain credibility without aggressive easing. Under this scenario, gold holds above $2,150 but does not accelerate dramatically. It becomes a higher plateau rather than the start of a vertical surge. Markets adjust to a new equilibrium where risk is managed, not eliminated. The system bends, but it does not break. This outcome would suggest that gold's breakout was an early hedge against stress that ultimately remained contained. The second scenario is more complex. In this path, liquidity fractures widen. Credit conditions tighten further than expected. Regional banks face renewed strain as commercial real estate or corporate defaults increase. Market volatility rises. Policymakers are forced to choose between defending currency strength and preventing systemic instability. If easing becomes necessary, whether through rate cuts, expanded lending programs, or indirect balance sheet growth, gold could respond more forcefully, not because of panic, but because future purchasing power would be repriced. In this scenario, gold's move above $2,150 would be remembered as the early phase of a broader revaluation. Bond yields might fall sharply as growth expectations decline. Equity markets could become more volatile. The dollar might weaken as monetary accommodation expands. But even here, the adjustment would likely unfold in stages, not overnight. The third scenario moves in a different direction. Imagine that growth proves more resilient than expected. Inflation remains sticky enough to justify prolonged, restrictive policy. The dollar strengthens as global capital seeks yield and safety. In this environment, commodities, including gold, could face temporary pressure. A stronger dollar often tightens global financial conditions, especially for emerging markets with dollar-denominated debt. Gold might retrace part of its gains as short-term positioning unwinds. However, if underlying debt burdens and structural imbalances remain unresolved, that strength could eventually sow the seeds for renewed stress. Tighter global liquidity can expose weak balance sheets. Over time, the cycle could turn again. Each of these scenarios is plausible. None is guaranteed. The common thread is adaptation. Markets continuously reassess probabilities based on new data. Policymakers react to constraints. Institutions adjust exposures. Investors reposition portfolios. Predicting exact price targets is less important than recognizing structural transitions early. When correlations break, when reserve allocations shift, when banks tighten while gold rises, these are signs that the system may be entering a different phase. The breakout above $2,150 is not just a number. It is a marker in time. A reference point that future analysts may look back on and ask, was that the moment when confidence subtly shifted? The real question now is not simply where gold goes next. It is what moves alongside it. If gold is signaling stress today, do bond markets confirm that signal? Do regional bank stocks begin to reflect deeper caution? Does the dollar maintain strength, or does it begin to soften as policy expectations change? Watching these relationships will reveal more than any single price chart. Because sometimes a breakout is just a technical event, and sometimes it is the first tremor of a broader monetary realignment. In the next analysis, we will examine whether this move represents the early stages of a larger reset in the global financial architecture, or whether it is simply another test in a system that has proven resilient before.